The following was recorded in front of a live studio audience at the Studio 21 Podcast Café. This is the United Podcast Network.
Welcome to the Stock Market Authority Podcast. I'm Bakes, Kevin Baker. I'm going to teach you how to make money in up and down markets. Very few podcasters or coaches cover this. I'll show you how to lock in profits and minimize losses to make you a better investor. So once a week, you're going to know what's going on in the world and the stock market. Welcome to the Stock Market Authority Podcast. Welcome. This is Bakes, Kevin Baker with the Stock Market Authority. I am thrilled to be back in the saddle again. Here at Studio 21, my producer Chrissy, she's been putting up with my Luddite tendencies, and we're finally back up and running. And I thank everybody, Leah and my boys, especially Bobby and Jack, who've been helpful with this. And I do it for them. They would ask me investing questions when they were in college, and then their friends would join in, and then it's grown to this. So we've been doing this, coming up on 2 years now. And, by the way, the guitar work is really outstanding in this, I think. That was me in the basement in the middle of COVID with my son taping me. Anyway, before I forget, please go to my website, stockmarketauthority.com. Please sign up for my free newsletter. Subscribe to my YouTube channel and podcast wherever you podcast. And follow me on social media. I want to meet you wherever you are. And my what I'm going to cover here today is, first of all, the title. Your stocks don't care about politics. Let me say that again. Your stocks don't care about politics. Your politics or anybody else's or the elections that are coming up next week, which is the reason why I'm covering this, because I've been getting so many questions about this. It doesn't matter, and I'm going to prove it to you in the next few moments. Number two, our second segment is Mailbag, which is my favorite. You firing questions to me at Bakes at stockmarketauthority.com or at BakesTakes_ on Twitter, whatever you want to do. And we're going to talk about uranium. I haven't talked about that in a while, but Murph brought it up, so here we go. Not that Murph, the dog that's in the studio. And then number three, we're going to go through the portfolio. And the reason I kept doing this with having all kinds of things that have delayed and caused problems is it's working. I didn't know it was going to work, but we're up in a down market. And my whole thing is, can you make money in up and down markets? And we're doing it. It isn't bragging. We've done it. And I think that it's a value, and I want to present it to you. And then I'm going to finish off with a flourish, with a conversation I had with my brother, and something that's going to lift you up. I'm always going to finish with something that lifts you up. I'm a pretty positive guy, and I want to lift you up as well. All right, your stocks don't care about politics. And here's the first long-term chart that we have here. This is the S&P 500 versus all of the presidents. And bear with me. I'm going to say something that's maybe controversial. It shouldn't be. Stocks drive elections and presidents and parties, not the other way around. I'm going to say that again. It's stocks that drive politics, not the other way around. And I know that there's going to be a lot of people on both the left and the right that argue with me. Well, I'm going to show you that it doesn't. Stocks are a reflection of social mood. It's millions and millions of people that are feeling either optimistic or pessimistic about the future and the companies they own, and reflected in values. And if it's up, the guy stays in because it's presidents. And if stocks are down and your wallet feels empty and your belly feels empty, you want to throw the bum out. So let's go to the ultimate. 1929, the Dow was at 381, and Hoover was in office. The crash happens in 1929, and stocks bottom in 1932 at 42. So what did they do? Hoover gets thrown out as violently as he possibly can be, and the market and the voting population says, we want who is ever more different than him. FDR steps in. FDR comes in 1942. With the Dow at 42, the market goes up fivefold in the next 5 years in the middle of the Great Depression. People don't realize that. It's one of the greatest bull markets ever. So people love FDR, the New Deal. The New Deal gets the credit. It was going to happen anyway. It's the social mood changed, and we're going to start to move up from those ridiculously depressed levels in 1942. FDR was in office not only for his first term, his second term, his third term, his fourth term, he's riddled with polio and not functioning well at all, and he dies in office. So the bull market was so strong that they wanted FDR in forever. If he had lived, if there was some technology to make him live, he would still be the president of the United States. I believe that fervently. So let's keep going. Truman, Eisenhower had bull markets post the war. The boys come back, GI Bill, chicken in every pot, and Chevrolets and refrigerators. Things are good, and so they stay in. Next, Kennedy gets elected in 1960. And arguably the most revered, cherished president in the United States. The bull market is so strong in the 60s that Kennedy is assassinated in 1963 with Walter Cronkite shocking everybody with this horrific news that we couldn't even imagine. And the market hardly blinked. It was down about 1% for a day or two, and then it kept marching on. And then Johnson comes in, guns and butter, up until 1968, and he leaves. Nixon comes in, about as different from Johnson as you can possibly ask. Now, this is where it gets really cool, I think. Stocks get crushed in 73, 74. Inflation's raging, the economy's lousy, oil, what have you. Nixon resigned on August 1974 so that he wasn't going to get impeached. Now, I believe that if he had a bull market, Watergate wouldn't have thrown him out. But because the trend was so negative and people were so angry and depressed and disappointed, they threw him out. Ford was a lame duck. Carter comes in 76. Nice man, but again, about as different as you can get from a Michigan football player. You go to the peanut farmer in Georgia, President Carter. 76 to 80, oil embargo, Iran hostage, just an absolute disaster. And stocks go down. And if the market's down, you get one term and they throw you out, and then the world and the voting population says, who's the most different? Let's go 3,000 miles to the left, to the west, to Reagan, a movie star, and let's bring him in. And Volcker is lowering interest rates. Stocks are starting to go up, and he gets in. They break 1,000 to the upside for the first time in forever. That lid is finally gone, and we're off to the races. It's a bull market. 84, he wins in a landslide, wins 49 states versus Mondale. So again, stocks are driving the politics. Stocks are driving the politics, not the other way around. Bush was the vice president. The market's still okay in 1988, and so he gets in. This is Herbert Walker. But he has a bad stock market, the savings and loan crisis, and he lasts one term, we throw him out, and they look for the most different thing they possibly can find. An Arkansas governor named Bill Clinton sure fits the boat. He comes in 92 to 2000, the tech boom, what have you, internet, the bubble, stocks rip, and he gets through. And his Watergate, Monica Lewinsky, wasn't strong enough to defeat the bull market, and so he stays in. And people will forgive a lot of things if their wallets are full and their bellies are full. And we see it time and time again, and it happened here. Bush comes in, the second Bush, 2000 to 2008. The great financial crisis hits, and so you got to get rid of him, even though he had absolutely nothing to do with it. It ensured the Democrats come in, and again, let's go, instead of having a Texas oil man, let's find a lifetime politician, a black politician up in Chicago. Barack Obama, he comes in, the quantitative easing and all the things the Federal Reserve did, which really drives stock markets, gives him a tailwind that lasts for 8 years. He stays in. And then, frankly, Clinton and Trump are so polarizing that personalities, frankly, snatched defeat from the jaws of victory. They had up markets, but enough people didn't like them, the deplorables and or the left, and so they didn't win. Now, Biden. I think Biden's going to make Carter look good. If the market continues to decline from here, and it might not, but right now he's in very, very tough shape, and we have the elections coming up, and I think it's going to be a red wave. Frankly, I'm not investing like that, though. I want you to hear me that the stocks are driving the politics, not the other way around. And I don't want you to do anything. I want you to vote your conscience and do your civic duty and vote in the things that you believe in, but don't invest with those. It just doesn't matter one shape or form, and I hope I've shown that to you. Here's another way of looking at it. And by the way, the market's up since Biden took office. People forget that, but he's about as popular as typhoid. His approval ratings are horrible because going up 28 and then down 24 feels so bad to people. It's really kind of shocking. But you have the FDR chart. I know this is tough to see. It's going to be a little bit blurry. But you have the FDR straight up to the right. He stays in for 3+ terms. And then you see what happens if you have a bad stock market. Carter, Hoover, Nixon, gone. And I think that's probably going to happen to Biden, is my guess. But again, I'm not investing like that. Another thing, these bills and political trends are going to help these groups of stocks. Here's the news from about a year ago. Biden signs the $1 trillion bipartisan infrastructure bill into law. Then you see the stock chart of what happens with the infrastructure ETF. I don't know if you can get that, Chrissy. The stocks didn't care. They peaked on the news, and then they faded the news, and the infrastructure bills have been lousy investments for the last year. And I think the same thing is going to happen with the recent semiconductor bill. Stocks are acting lousy, the Intels and what have you. Hillary and healthcare in '94, we killed a lot of trees, spilt a lot of ink, wasted hours on conference calls that I'd love to get back, and she was going to take over and revamp healthcare. Nothing happened. We all wasted our time, and if you had just invested based on what the stocks were doing, you'd do a much better job. So please do not let politics influence how you invest. Now, here's the next one. This is the presidential cycle. And J.C. Peretz from All Star Charts, I'm a fan. This is something he's been talking about, and a lot of people have been talking about. First of all, congratulations, Morgan and J.C., to your twin boys. That is fabulous, and I can't wait to see you back in the saddle, J.C. But this is the presidential cycle, and this is, as it shows on the chart, the trend is more important than the level. The first year is usually the honeymoon. The second year, which we're in now, stinks. And then we start to lift off right around now for a Santa Claus rally for the next 2 years. It could happen. There are exceptions to this rule. This is being talked a little bit too much for my liking on Twitter, where I think it's conventional wisdom that the market likes a gridlock. So the Democratic president, Republican Congress, no one squanders too much money, and it's good for stocks. That could play out, but I think it's conventional wisdom, and so I'm not buying that 1,000% right now. I am looking at thousands of ETFs, and I'm simply not finding a lot of things to buy that play into that thesis. So I'm looking for them. I'm going through them right now. This is Barron's. I put every ETF that's out there into my MarketSmith system, which I really recommend, by the way, MarketSmith. And I go through thousands of ETFs for you, so you don't have to, every single month. And I'll come back to you with, here are the things that I think we should be investing going forward. But right now, I don't see it. All right, our next segment, this is the mailbag. And this is I love this. Murph writes in about uranium and asks for an update. I haven't talked about it in a while, and I'm pretty proud of this. And this is a good example of what we do here. Uranium, URNM, this is the uranium miners. I started talking about this at the very beginning of the show in July of 2020. You see this red arrow here. We bought it at $30, and I had to really up my game on uranium to find out why this bull market was going on. I still think it's a bull market, but I've sold because I have a very strict technical sell discipline. So here we are, uranium's at $50 spot. I think we eventually go up to $150, the all-time high, but it's not happening yet. So I invest in the stock market I have, not the one I wish for. And so when this closed below this 200-day on the chart, and then my sell discipline kicked in, and I sold the remainder back in June. The average was 60 when all is said and done, and we doubled our money. And go back and look over that 2-year period, how many 100% winners with long-term capital gains did you take? And I like to think that we added value. The other thing I'll point to is I doubt very seriously that any Merrill Lynch or Goldman or any financial advisor tapped you on the shoulder and said, yeah, you should be 10% in uranium, and here's why. So I like to think I look around corners a little bit to where people are not looking and give you ideas that you're not going to hear anywhere else, and I hope this fits the bill. Recently, I thought we were going to go for another leg up. Okay, so I make mistakes, but I make 15% mistakes, and then I shoot them. So I cut my losses here. I am gone, and I'm looking for a reentry. I think the bull market's intact. I think this is ESG personified. I think nuclear is being rekindled around the world. It's going to be very interesting what happens with energy in Europe this winter, and I think there's a renaissance going on in nuclear, but it's not here yet. And so I look at it every month, and I'm looking to find a reentry point. I just don't see it yet. Next, Sofi. Basil, I think I'm pronouncing that right. Basil, sorry if I'm butchering your name. I really apologize. Came into me through YouTube. Thank you for subscribing there. I really appreciate that. And make a long story short, this is losing money. The company itself is losing money. There's no end in sight. And in this environment, a fintech that's losing money is not going to get any love. Financials are acting lousy and tech is acting worse. You combine the two and you have what you have here. I think also the student refi story that was a big linchpin of the thesis is less attractive now. Biden has forgiven a lot of the loans that is being debated and being challenged in courts, obviously, but also just interest rates. The average interest rate on a student loan is 6 3/4. The SoFi, you look at it and they can maybe refinance at 4 3/4, 5. And is that worth it for most of the borrowers out there? I don't know. Do you want to go through the headache of all this to save that 2%? We'll see what happens. So I think it's going to happen, but I don't think it's going to be monolithic and improve the income statement that much of SoFi. Credit quality is going down. Maybe not dramatically, but it's not going up. And so, to me, SoFi is dead money. There's no life in this chart. I will alert you if I see anything else, and please fire more questions at me that I can be helpful with. Charlie asked about CDs versus money market funds. And Charlie and everybody, I keep things really simple. If I want to be safe and liquid, and you want to be safe and liquid, then be safe and liquid. That means CDs have a term, 1, 2, 3 years, whatever. And so you lock up the money, you earn a slightly higher interest rate, and then it matures, and you get your money plus the interest back in a year or 2 or 3. So a CD might have a 4% interest rate, money markets maybe 3-ish. And is that 100 basis points, 1%, worth it to you? It isn't worth it to me. I'm 21% in cash in the portfolio, by the way, because I want to be poised to jump on opportunities that chart work that I suggested brings up. And so for right now, not for me. Next segment. our portfolio, Bake's portfolio, the Stock Market Authority portfolio, which I hope you're following. I'm going to get to that. But first, I wanted to point to this. I'm driving Chrissy crazy here because I'm sending her poor quality images. But this is a tweet that I really like from Dan O'Shaughnessy. And first of all, he talks about how what we do looking for trends continues to work. And what's not working is trying to find earnings upside surprises that people are unaware of that drive stock prices going away. And I see firms that relied on upside earnings surprises for their livelihood, and they're gone because full disclosure in 2000, maybe 2001, but around there, arbitrage that away. In the good old days, you could go out and, don't tell anybody this, kids, but you go to the conferences, you take the CFO out, he'd have an extra scotch, and you kind of got a sense that the earnings were going to be okay. And the guidance was going to be okay, and you smile and you held on to your position or you added to it. Those days are gone. They have to, put everything out to everybody, and it's been arbitraged away in Dan O'Shaughnessy's world. So this is one of the best tweets I've seen in a long time because it's stapled to Dan Benton's top 20 rules for investing in technology from the 90s, and it's as valid today as it was then. He's a Goldman Sachs analyst. Dan, thank you for your work. I'm not going to go through all of them, but number one is sell technology stocks when estimates are being reduced. Pretty straightforward, and I can't tell you how many people fight this and say, oh, it's a one-quarter problem, and they'll make it up. It almost never is. Number 4 on his list is most technology stock ideas are product cycle stories. See Apple. That's exactly what it is. And you can go through other iterations and other stocks. And so, if the product cycle is waning, you got a bad place to be. And don't forget rule number 1. All of his rules are worth going through, and I have it here in the show notes for you. But I think that I'm going to bring up the earnings coming down, the estimates coming down in the next in a few minutes, because I think it's very germane to what we're investing right now. I think you can crush the pros, and here's how. And this is sort of Money Management Confidential, my play on Anthony Bourdain. The money management world picks up a lot of steaks off the kitchen room floor and dusts them off and puts them on the plate. Number 1, I think you have to ignore the indices. And what happens in the mutual funds, institutional firms, and hedge funds that I've worked in for 25 plus years, there's a portfolio manager. And he has his style and his book, and everybody sort of adheres to that. But they don't really, because then you have a healthcare, a financial, a technology, a retail analyst, and you come from different experiences and different things work for you. I had to basically carry charts under my coat because you had to be a fundamental analyst. And I do that really, really well, but I make sure that I'm doing that fundamental work on technical charts that show me that there's something positive going on. And so then they say you have to compete against the Russell 2000 or the S&P 500, and they hug the indices. If it's 25% if technology is 25% of the index, you're going to be 21, 29, maybe, but you're not going to be 35 and 15 because it's just, if you're wrong, you have a lousy meeting with your pension consultant client at the end of the year. So they hug the indices way too much, and then you have to make sure that you get the right stocks in that part of the index, and that your analyst is good enough so that he can find an extra 3-4% over that part of the index, so that you outperform. And they just don't do it. We see it time and time again, and the graveyard of money management is littered with a lot of this. You don't have to do any of that. All you care about, and all I care about, is I want to make money every single year. And that sounds audacious, but I refuse to do what everybody else did on January 2nd, is say, we're going to lose less than everybody else. We're going to have enough cash, that stays under our mandate, so we can be 7% in cash, maybe up to 8%. And then we're going to try and lose less in this. We're going to try and fade technology. We're going to try to get energy up. And it's just, you don't have to do any of that. You just follow the groups that present themselves, and I'm pretty good at identifying these, I think. So what I do is I go through my thousands of ETFs every single month that cover everything, every country, every commodity, every market cap, and there's something going on that's good. And out of those thousands of ETFs that I go through for you, I find 10 that I think are the best. And that's how we're doing. So here's the portfolio. And pretty proud of this. And I can't be more transparent. This is an actual account. This isn't a model portfolio. This is me putting my money where my mouth is and finding the best ETFs and imparting the discipline that I've talked about. We're up 5.83% through the end of October. The S&P is down 18 plus. And I think that's pretty darn good. And I don't care about relative performance. Here's something to key in when you listen to the talking heads of CNBC or elsewhere. Talking about underperformance, outperformance, that's the institutional game, the pros game. They get paid to be down 14 versus down 18 in the S&P. They get high-fived and they get to work next year. I want you to be up every single year and compound that. And psychologically, be on offense all the time, be on the balls of your feet all the time, and not licking your wounds from god-awful mistakes that are down 50, 60, 70%, which is what happens in so many cases. So I'm not going to go through all the stocks for the interest of time, but I'm going to go through a few things. Number one is the ETF, Matthew Tuttle, who we had on the show. Great guest, great episode, one of our most popular. He's now at AXS, and he created this ETF that shorts the SPACs. What are SPACs? Special Purpose Acquisition Companies. And so Chamath Palihapitiya, I know that's a mouthful, would raise hundreds of millions of dollars, a lot of his own money too, to be fair. The stock would be, it'd be priced at 10, and then they go look for a company to acquire. The companies that are getting acquired don't want to go through the Goldman Sachs and Morgan Stanley investment committee gauntlet. They're lower quality, period, end of discussion. That's just the way the world works. And so what Matthew would do would find the most recent 25, put those in the ETF, and then see what happens after they de-SPAC. So we bought this, as you can see from the arrow here, July of 2021 at $25. We're up 73% since inception, and we're up 50% year to date. Pretty good, right? I think. And so why does this work? I always like to go to see the top one or two holdings in the ETF, exchange traded fund, if I didn't say that before, and see, does this make sense why this would be going up, why the underlying stocks would be going down, the shorts, and why the ETF would be going up. This is Aurora Innovation, AUR, and this is self-driving vehicles. I mean, this is just classic kind of 1921 free money activity. We're all going to be sitting in the back seat. We're going to have a digital chauffeur that carries us around. It's obviously ridiculously complicated to do. We've been talking about this for 10 years. We'll be talking about it for the next 10 years. And so as you see in Aurora, priced at 10, stock goes up 70% when they say, okay, we're going to buy Aurora and make that into, bring this into the SPAC. 17's the peak, and then all they've been doing is incinerating money since then. We're here at 2. And it's the biggest position in this particular ETF. And the possibility of going to 0 is there, absolutely, in my view. So that's just an example of the kind of things, and again, there isn't a financial advisor out there that's going to say, hey, I think you should be shorting self-driving vehicles. But I just go where the money is, and I just think this makes sense. Number 2, short the innovation ETF. Now, I'm sure the lawyers tapped him on the shoulder and said, hey, I know you're shorting Kathy Wood's ARK, A-R-K-K, but don't do that. Leave her name out of this. But what did they short ARK, A-R-K-K, the disruptors, the innovators that Kathy Wood espouses very vocally and very successfully. But November 21st, this showed up on my radar screen. We bought it at 34. We're up 73% since inception. We have another month or so. We're going to have a long-term capital gain that brings the tax bill down if and when we sell it. And I just think it's another example of the kind of things I'm going to be talking about on the show, in the newsletter, and when I break in on videos and social media. And oh, by the way, the SARK ETF lifted off, and I bought it when almost to the month when Tesla peaked. in November of last year. I call this Kathy Wood's cleanest shirt. There's a great I'm showing you my age, Johnny Cash song, Sunday Morning Coming Down, and he talks about getting his cleanest dirty shirt to wear. And this is the best looking stock she has in a list of 30 plus really, really ugly charts, in my opinion. And here the estimates are coming down. It's hard to see in the chart, but we were at $6 plus in 2023. The estimates came down, are starting to come down, and then the Dan Benton rules that I talked about kind of echoes in my head. This is a car company, not a technology company to me, but it's priced like a technology company. So estimates are coming down. This chart is clearly rolling over. It trades at 38 times that next year number at 585 that they're likely not going to make, in my opinion. It's a car company in a recession, and 38 PEs with all those things I just mentioned are going to be tough to sustain. Anything's possible, but I doubt it. If it closes below 200, you're going to 167. I know a lot of you are Elon Musk acolytes. He's a brilliant man, controversial man. It's a great product. It's a great car. I don't think it's a good stock. And so via the SARK ETF, we're participating on that short side. Number 3, Tecurium Agriculture. Back in January, you see this red arrow. We bought it at 22. It owns a fourth of sugar, corn, wheat, and soybeans. Again, no one came up to you, I don't think, and said, hey, let's go buy the softs, as they call them, the agricultural stocks. We locked in profits on 2/3 of the position thus far. We're up 41% for a long-term capital gain. And do me a favor, be honest with yourself. Go back at that prior period. Look at your portfolio. Do you have a lot of 41% winners? And if you don't, I'd really appreciate you subscribing and paying attention and sharing what we do here. So our current positioning, we're 68% short SPACs, ARK, emerging markets, especially China, the Qs, which is the NASDAQ 100, Apple, Microsoft, Amazon, etc., and Tesla, by the way. We're short the Russell 2000, the small caps. We're short real estate, the financials, and the big European stocks, EAFE. We're long agriculture and small cap energy to the tune of 11%, and we're 21% in cash. So I think we're hedged. I think we're diversified. I think we're nimble. I think we have all kinds of flexibility. And if you think this is something you'd want to have for your own portfolio, at least a portion, then we ought to talk. All right. Lastly, my last segment here. I used to call this much-needed levity because I go through some heavy stuff. I don't mean to be. I'm a pretty positive guy. I got a phone call this past week, well-timed, by the way, from my brother Kent. Said, hey, just thinking of you. I love you. And then sent me on my phone Desiderata from Max Ehrman. Why is that? First of all, I'm very blessed. I'm blessed that my brother wants to do that. I'm blessed that Suze loves me, my lovely wife, Bobby, Jack, my boys, and Mom and Dad. Dad had Desiderata on his wall forever. And it's from Max Ehrman in 1927, and I think it's absolutely wonderful. Here we go. This is the way I'm going to finish. I won't be this serious many times, so stay with me. Go placidly amid the noise and haste, and remember what peace there may be in silence. As far as possible, without surrender, be on good terms with all persons. Speak your truth quietly and clearly, and listen to others. Even to the dull and the ignorant, they too have their story. Avoid loud and aggressive persons. They are vexations to the spirit. If you compare yourself with others, you may become vain or bitter, for always there will be greater and lesser persons than yourself. Enjoy your achievements as well as your plans. Keep interested in your own career, however humble. It is a real possession in the changing fortunes of time. Exercise caution in your business affairs, for the world is full of trickery. But let not this blind you to what virtue there is. Many persons strive for high ideals, and everywhere life is full of heroism. Be yourself, especially do not feign affection. Neither be cynical about love, for in the face of all aridity and disenchantment, it is as perennial as the grass. Take kindly the counsel of the years, gracefully surrendering the things of youth. Nurture strength of spirit to shield you in sudden misfortune, but do not distress yourself with dark imaginings. Many fears are born of fatigue and loneliness. Beyond a wholesome discipline, be gentle with yourself. You are a child of the universe, no less than the trees and the stars. You have a right to be here. And whether or not it is clear to you, no doubt the universe is unfolding as it should. Therefore, be at peace with God, whatever you conceive him to be. In whatever your labors and aspirations in the noisy confusions of life, keep peace in your soul with all its sham, drudgery, and broken dreams. It is still a beautiful world. Be cheerful. Strive to be happy. Please go to my website, stockmarketauthority.com. Sign up for my free newsletter. Subscribe to my YouTube channel and podcasts. Follow on your favorite social media. Please email me, bakes@stockmarketauthority.com. DM me on Twitter @BakesTakes_. Thank you very much. Welcome to the Stock Market Authority. I'll see you soon. Keep smiling. I'm Bakes.
The views and opinions expressed by the hosts, guests, or callers of this program do not necessarily reflect the opinions of the Studio 21, Podcast Café, the United Podcast Network, its partners, or affiliates.